Hello everyone, welcome to EPK Capital's deep dive video. In this series we analyze one company each day based on the security analysis by Benjamin Graham. Today we are going to talk about Walt Disney Company. The Walt Disney Company, with its stock trading around $112, many investors are asking the same question. Is now the right time to invest in the House of Mouse? Let's break down everything you need to know about Disney's current position, financial health, and what the future might hold. The company and its leadership. The Walt Disney Company isn't just any entertainment company, it's a global empire that has been shaping childhood memories and cultural experiences for over a century. Founded on October 16, 1923, by brothers Walt and Roy Disney as the Disney Brothers Cartoon Studio, the company started with a simple contract to produce Alice comedies. From those humble beginnings in a garage, Disney has grown into one of the world's largest entertainment conglomerates. At the helm today is Bob Iger, who returned as CEO in November 2022 after a brief retirement. Iger isn't new to Disney's top job. He previously served as CEO from 2005 to 2020, during which time he transformed Disney through major acquisitions including Pixar in 2006, Marvel in 2009, Lucasfilm in 2012, and 21st Century Fox in 2019. His return came after the board dismissed his chosen successor, Bob Chapek, amid various challenges facing the company. Under Iger's leadership, Disney operates through several key segments: Disney Entertainment, movies and streaming, ESPN, sports content, and Disney experiences, theme parks, cruise lines, and consumer products. The company's vast intellectual property portfolio includes some of the most valuable entertainment franchises in the world, from Mickey Mouse and Disney classics to Marvel superheroes, Star Wars, and Pixar animations. 10-year financial performance, a story of growth and challenges. Let's dive into the numbers that tell Disney's financial story over the past decade. The data reveals both impressive growth and significant challenges that investors need to understand. Revenue growth. Disney has demonstrated solid long-term growth, with revenues expanding from $52.5 billion in 2015 to $91.4 billion in 2024, representing a compound annual growth rate, CAGR, of 6.36%. However, this growth hasn't been smooth. The company faced a significant setback during the COVID-19 pandemic, with revenues dropping to $65.4 billion in 2020 due to theme park closures and theatrical shutdowns. Profitability challenges. The profit picture tells a more complex story. While Disney earned $8.4 billion in net income in 2015, recent years have been more challenging. The company actually posted a $2.9 billion loss in 2020 and has struggled to return to previous profitability levels, earning $5 billion in 2024. This represents an earnings per share of $2.72 in 2024, still below the $8.40 EPS achieved in 2018. Debt management. Disney's financial structure has changed dramatically over the decade. Total debt increased from $17.3 billion in 2015 to $49.5 billion in 2024, though it peaked at over $62 billion during the pandemic. The debt-to-assets ratio currently stands at 25.2%, which is manageable but represents a significant increase from the 19.7% ratio in 2015. Margins under pressure. Net profit margins have compressed significantly, falling from 16.0% in 2015 to 5.4% in 2024. This reflects the challenges Disney faces in its transition to streaming, increased content costs, and the recovery of its theme parks business. Technical analysis. What the charts tell us from a technical perspective, Disney's stock tells an interesting story of both struggle and potential recovery. The stock is currently trading at $112.25, sitting between its 52-week low of $81.72 and its high of $124.01. Over the past 10 years, Disney has seen dramatic swings, reaching a peak of $201.91, but also falling to lows of $79.32 during the pandemic sell-off. The Relative Strength Index, RSI, currently stands at 31.9, which suggests the stock is approaching oversold territory without quite reaching it. This neutral to slightly oversold reading could indicate potential for upward movement if positive catalysts emerge. Key technical levels to watch include support around $85.81, just above the 52-week low, and resistance near $117.81, approaching the 52-week high. The stock's current position suggests it's in a consolidation phase, potentially building a base for future moves. Looking at the long-term performance, Disney shareholders have experienced a total return of just 11.56% over the past 10 years, significantly underperforming the broader market during this period. This underperformance reflects the various challenges the company has faced during its transformation. Benjamin Graham valuation, a value investor's perspective. Applying Benjamin Graham's famous valuation formula, the father of value investing's approach to determining intrinsic value provides some sobering insights about Disney's current valuation. Using the Graham number formula, which calculates the square root of 22.5 times earnings per share times book value per share, Disney's intrinsic value comes to approximately $58.01. With the stock trading at $112.25, this suggests Disney is currently overvalued by about 93.5% according to Graham's conservative value investing principles. The Graham formula uses Disney's 2024 earnings per share of $2.72 and book value per share of $55. This significant overvaluation according to Graham's metrics doesn't necessarily mean Disney is a poor investment, but it does suggest that investors are paying a premium for future growth expectations rather than current asset values. It's worth noting that Benjamin Graham's approach was designed for a different era and may not fully capture the value of modern intellectual property and brand assets that Disney possesses. However, it provides a useful baseline for understanding how far the stock price has moved from traditional value metrics. The bull case, reasons for optimism despite the challenges. There are several compelling reasons why investors remain optimistic about Disney's future prospects. Streaming transformation. Disney's direct-to-consumer business is showing promising signs of improvement. The company expects significant margin expansion in its streaming segment, with projections suggesting margins could grow from 0% in fiscal 2024 to over 13% by fiscal 2028. Disney Plus recently added 1.8 million subscribers in the most recent quarter, and the upcoming ESPN direct-to-consumer launch is expected to boost average revenue per user by 25% year-over-year. Parks recovery and expansion. The theme parks business, which generates nearly 40% of Disney's total revenue, continues to show strong performance. The company is investing heavily in expansion, including 2 new cruise ships launching in fiscal 2026 that are expected to contribute over $1 billion in revenue. Parks have shown resilience with strong booking trends and pricing power, supported by Disney's unmatched intellectual property portfolio. Unrivaled content portfolio. Disney's content library remains its crown jewel, featuring over 20,000 films and TV shows including the Marvel Cinematic Universe, Star Wars, Pixar animations, and classic Disney properties. This content provides multiple revenue streams through theatrical releases, streaming, merchandise, and theme park attractions. The company's focus on quality over quantity in content production is expected to improve margins while maintaining audience engagement. Financial discipline. Under Bob Iger's returned leadership, Disney has implemented significant cost-cutting measures, achieving $1 billion in quarterly operating income improvement in its streaming business. The company has also reinstated its dividend and authorized a $3 billion share buyback program, signaling confidence in its financial recovery. The bear case. Challenges and concerns. However, Disney faces significant headwinds that investors cannot ignore. Cord-cutting acceleration. Disney's traditional linear TV business, particularly ESPN, continues to face pressure from cord-cutting trends. ESPN has lost over 13 million subscribers since 2011, dropping from about 100 million to less than 87 million. This decline affects one of Disney's most profitable segments, as ESPN historically contributed about $4 billion in annual cash profits. Streaming competition. The streaming landscape has become increasingly competitive and expensive. Disney must compete with Netflix, Amazon Prime, Apple TV+, and numerous other platforms while investing heavily in original content. The company's content spending remains substantial, and achieving profitability in streaming requires maintaining subscriber growth while controlling costs. Economic sensitivity. Disney's business model is highly sensitive to economic downturns. Both theme park attendance and streaming subscriptions can decline during economic stress, while the company's high fixed costs create operational leverage that works against it during downturns. Content fatigue. There are concerns about potential fatigue with Disney's major franchises. Some analysts worry that Star Wars and Marvel brands have become diluted with excessive TV shows and movies that erode consumer sentiment, which could impact future content performance and related merchandise sales. Important controversies and market position. Disney recently navigated a significant political controversy with Florida Governor Ron DeSantis that lasted nearly 2 years. The dispute began in 2022 when Disney criticized Florida's Parental Rights in Education Act, leading to the state revoking Disney's special self-governing privileges that had been in place for over 50 years. However, the two parties reached a settlement agreement in March 2024, ending the legal battles and allowing Disney to focus on its business operations. While this controversy created uncertainty and legal costs, the resolution removes a significant overhang that had concerned investors about Disney's relationship with Florida, where Walt Disney World is located. In terms of market position, Disney remains a global entertainment leader with operations spanning 6 continents. The company's theme parks in California, Florida, Paris, Tokyo, Hong Kong, and Shanghai provide geographic diversification, while its content reaches audiences worldwide through multiple distribution channels. Investment conclusion: a balanced perspective. After analyzing all these factors, Disney presents a complex investment picture that requires careful consideration of your investment timeline and risk tolerance. The company is clearly in transition, moving from traditional linear TV towards streaming while maintaining its core theme parks business. This transformation involves significant near-term costs and risks, but also offers substantial long-term opportunities given Disney's unmatched content portfolio and global brand recognition. From a valuation standpoint, Disney appears expensive based on traditional metrics like the Benjamin Graham formula, suggesting investors are paying for future growth rather than current asset values. However, the company's unique intellectual property assets and market position may justify some premium valuation. The technical picture suggests the stock is in a consolidation phase, with potential support around $85 and resistance near $118. The RSI reading of 31.9 indicates the stock isn't dramatically overbought, leaving room for upward movement if positive catalysts emerge. For investors, Disney might appeal to those who believe in the company's ability to successfully navigate its streaming transformation and leverage its content advantages. However, the investment requires patience as the company works through margin pressures and competitive challenges in the evolving media landscape. Risk management. Given the various uncertainties, investors should consider position sizing carefully and maintain realistic expectations about near-term performance while the company executes its strategic transformation. Important disclaimer: this analysis is for educational and informational purposes only and should not be considered personalized investment advice. All investing involves risk, including the potential loss of principal. Past performance does not guarantee future results. Before making any investment decisions, please conduct your own research and consider consulting with a qualified financial advisor who can assess your individual circumstances, risk tolerance, and investment objectives. The views expressed in this analysis are based on publicly available information and may not reflect the most current market conditions or company developments. And that's all we had for this video. Thanks for watching. If you found this video valuable, please hit the like button, subscribe to our channel.